All right, enough history. Let's get into another stock, which is ServiceNow, requested by Falls Grave. Good to see you, Falls Grave. It's under a little bit of pressure. Now, this stock, man, look at that chart. Daryl, what's going on here? Now, this business, you look at this chart and you're like, now we saw some charts where the revenue was a little bit of growth, the profit wasn't all that great, yada, yada, yada. So on the surface, you're like, boy, the fundamentals are going to look bad because this communicates to me high level. We're in for seeing some ugly numbers. So let's take a look. And the forward P is 25. This is a software as a service company. They focus primarily on, I'm going to call it service events. So if you're in IT, or excuse me, if you're at a company, you need IT support on an issue you're having, ServiceNow, or everything ticketing wise, that's where they started. And they're doing other things as well. They're big into that space. It's part of CRM. It's part of customer experience. That's where they play. Their CEO was a CEO of SAP for a long time. And before that, he worked at Oracle, which is somewhere where I worked for a long time. So Bill McDermott, super quality CEO, really charismatic. If you watch him speak, that guy's got talent, man. He can have his own talk show at night if he wanted to. This company, again, stock price is going down. We were seeing some stock prices that were flying up that were 7% growers. This thing's growing at 21%. All right, looks good, but do they get to keep a lot of that revenue in the form of profit? Absolutely. Look at this, 77.5%, 13% profit margin, free cash flow margin of 34%. So when they're growing by that 21%, they get to keep a lot of that money on that balance sheet, ready to go, ready to invest in AI, ready to grow their business, acquire other businesses. So this business continues to grow. And the big story is AI can potentially create new competition for ServiceNow, because developing software factually has gotten much easier, period. It's gotten less expensive. Developing software, right? Just a crash course. We all know what computers are, right? It's a CPU, it's a user interface, and that software behind it. For a long time, the moat was having an organization with the knowledge to be able to develop software and put that knowledge into products that were very useful to companies or individuals. And then those individuals or companies get so much value, they're willing to pay a subscription for it. And voila, that's the software business. And AI is putting the new threatening story of, well, now more companies are going to come to market with their product to do ticketing, customer service, and so forth. And it's going to be new competition to ServiceNow. That's absolutely a rational expectation. I agree with that. But the other piece that we need to keep an eye on is if I remember when Hewlett Packard, when they were great, right? Now Hewlett Packard's not as great. I'm sorry to say, but in the 80s, Hewlett Packard was Apple. It was NVIDIA. It was super cool, right? You remember Hewlett Packard in the 80s?
Yeah, I was a big fan. I worked on a lot of their equipment, so I'm
They had a
very familiar with
philosophy.
them.
I read it in the Wall Street Journal. That's back when we read newspapers. And they would self cannibalize their own products. They had a philosophy that we need to look at our products and we need to disrupt them. Because if we don't disrupt them, another company will. And that's a threat. If I disrupt my own product, I get the future revenues. If my competitor disrupts that product, they get my future revenues. So that was their philosophy. And it was a very good philosophy. Somewhere along the way, they lost that mojo. They lost that culture, and Hewlett Packard's never been the super cool, super valuable company. ServiceNow has to disrupt themselves. They have to say, hey, in 2025, we used to do it this way. In 2027, it's going to be fantastic. The UI is so much better. You literally just talk to your computer, and I'm just making this up, and it creates a service ticket for you. It does this, that, and the other. They wow their customer like, geez, man, you guys are so far ahead of the competition. You got these small businesses coming into the space saying, hey, look at me. And you guys are better than that. They have to stay there. And that'll be measured by this line. Revenue growth. Right now, it looks great. But you know what? The market is like, you're guilty until proven innocent. Okay? It's not like they don't have the same rights as us citizens. And they're going to have to prove that they're going to grow, and they have to grow. They have to accelerate their growth. If ServiceNow begins to slow their growth, the stock price is going to just continue to be under pressure. They're not going to get out of this corner they're painted in by the market. So, I mean, I look at the numbers and you're like, geez, this is a really good looking business. Let's look at the forecast. One analyst is like, man, he must work at ServiceNow. Look at that. He must have like 80% of his portfolio in ServiceNow. But now we have 51 analysts, 50, 20. Okay, this is a pretty good group of intelligent analysts. And could they be biased? Absolutely. But bias means their numbers are 10% a little too good. They're 10% a little too pessimistic. Okay. They're still kind of in the ballpark. And when they're telling me, hey, this business is going to grow by 21, 18, 19%, and 18, there's no disruption baked into those numbers. It's expected that ServiceNow is going to grow, and their margins are excellent. Forgot to cover margins. We'll come back to it in a little bit. Their profits are going to expand. Look at that. Let's pretend that ServiceNow, just for the moment, is not a software company. They're actually doing financial services, or they're doing industrial, and they do services around power generation. This stock would be like flying off the charts, just screaming higher, because the market has this story in its mind that we're not too sure about software. We think AI is going to change it. Absolutely, it's going to change it. It should change it. I've been using AI, and I'm just completely blown away by OpenClaw, Claude, Cowork, ChatGPT, Gemini. Those apps have made a big difference in my individual work as a stock investor. I'm just completely blown away. But ServiceNow has access to all those technologies. They're not going to sit around and say, oh, game's over. Let's just go ahead and call it in. No, they're going to be like, look, get our engineers, get our developers. We need to be the first ones to the market that offer XYZ feature set that is going to blow our customer base away. They're going to love us. We're going to go grab new customers. We're going to do so. So that's what I'm seeing in the software space. Let me qualify my opinion a little bit. I worked at Oracle for more than 20 years. And before that, I was a consultant helping businesses select software systems and putting them in their companies. I worked with CRM companies like Siebel way back when, Salesforce, implementing using Salesforce, Oracle, SAP, which has CRM. So this is a space that I have knowledge on. It's something that I put my hands on and worked on. I wanted to take a look at some margins because they're growing nicely. I did look at the margins. Forgot that. So this is a really good opportunity. I think the software space right now, these companies, they're they're upset. They're they're like, you know what? It's like that football team that plays with a mean defense that doesn't get the respect. A little bit like the Seahawks. I don't think the Seahawks are getting enough respect this past season. Their defense was, man, I'd hate to meet those guys in a dark alley. Maybe they'd be pretty cool guys. Who knows? ServiceNow, Salesforce, Intuit, they're upset. They're like, we're under threat. And they know they're under threat. And they have to define their future. They have to create products that are going to blow us away. Or somebody else will blow us away and ServiceNow will not exist. Or they'll just be a shell of what they used to be. So I'm going to pop into my valuation because the software space is somewhere where I am invested, and I'm invested long term. I'm waiting for the market to kind of pivot. And look at this. Our friends over at Google, their stock's up a lot, but their darn updates to my Google Sheet are not working, Daryl.
Uh-oh.
Well, I'll take the stock increase and deal with the issue I'm dealing with because I own so much darn Google stock. Oh, there we go. Okay. See, I badmouth them a little bit and they fixed the problem. 39% discounted ServiceNow. Now, I'm not a ServiceNow stockholder. I own Salesforce. I think Salesforce gives me a better proposition, but it's a buy. ServiceNow is a buy in my book. It's got a fantastic structure to their profitability growth. I think they're going to, again, they're upset that the market's counting them out. The ServiceNow is a really good company. And I think they're going to come out with awesome products. And there's really good value in software. So that's what I'm thinking. But I would like, because I think nobody's going to argue with the numbers. The numbers are the numbers. Numbers are a very rational, quantitative process. But the qualitative and the technicals are what are going to be critical to study, which is why I'm going to turn things over to Daryl and I'm going to be very attentive because when things begin to move in software, I'm going to load the truck with software stocks. Go ahead, Daryl.
So we're going to start off with a 5-year view, and we've had these lines drawn here for quite a while. Basically, they're just connected to some prices that it's traded at several times in the past. And then we have another one here where it's connected to several of those resistance points. So just to give you some idea of why those lines are there, because it did break down below that top auto support resistance line. They haven't really recovered except for a day or two. And they haven't quite made it down to the $93 level. And we have a double bottom here. So this might be really good support right where I have my crosshairs set at 99 and they're trading at 104 at the moment. They are trading down from where they were yesterday, but above where they were a couple of days ago. We didn't have really good volume. It was below average volume on these buys right here. So we have an RSI that's sitting right around 40. So that's in bearish territory. We have PPO that's in bearish territory. We have had quite a bit of distribution over the past couple of months. Looks like we had 1 day of accumulation on the 30th, and then yesterday was another distribution day. Money flow is currently negative. So if we go back out to that 3-year view, I'm going to show you fast graphs here in a minute. But we can see these quiescent levels that they trade at, and then markets at times just get very exuberant, and the price really runs up, above where those quiescent levels are. So anytime this is happening, I think you have to be very careful and manage risk very well. Or if you don't sell, you're going to be pretty much a bag holder at some point. So let's look at ServiceNow in fast graphs. So the gold line is their fair value based on a 34 time earning PE because of their growth is high, 19%, 20%, 21% in the 3 out years. They've had 26, 29, 42, 28 over the past 4 years. So they're definitely growing. They get a high PE. The market has traded them more at this level. They've been trading below that level for basically since the beginning of 2022. So the market isn't applying the same premium that they did from 2016 to 2021. So, if you're buying up here, you're taking on a lot more risk because they're trading above what the market typically applies to them as far as a PE and what the fair value is. Currently, they're trading below their fair value. To me, this looks like a much better entry point than, anywhere probably in the last 9 years. So anyway, I mean, if we take where they traded at the close yesterday, and even if they just trade at fair value, and I don't know if they're going to go much below that based on the threat from AI, but you're looking at a 33% annualized return between now and 2027. So this is a much better price. And, if you're buying up here, I'm sorry, but you were paying too much for it based on the chart and their valuation. So sometimes it's good to be patient and just wait. Or if you're going to buy it up here, be willing to step out if it's not working. But to me, this looks like a good entry point. I don't own this one. I've never owned this one. I don't have any interest in owning this one. But if I did, this is where I'd be getting interested.
Very good, sir. So I'm doing some trades here. Sorry. Let me get back to you. What we're talking about here. So here's a I think a tougher question. And maybe it's for a future conversation is put yourself in my shoes and you're looking at the software space as potentially a space that's going to be worth 2 to 3 times more in the next 2 to 3 years. That's really my mindset is if these software companies can prove that they are going to disrupt themselves and say, yeah, you're right. AI is going to disrupt the product we were making 5 years ago. The product we're making for 2026 is far better and it's the UI is different, so forth. But it happens to be a disruption that ServiceNow disrupted ServiceNow. And now we're actually charging more for the product. And we actually have better margins because it used to take us 100 engineers to do a particular product. Now it takes 10 or 5, right? So given that, what are you looking for that would tell me, you know what, this thing's has the potential to continue to go higher from this point forward?
Oh, that's a good question.
And maybe that's the topic we can kind of take as a homework item and kind of beat it up a little bit.
Yeah.
Because somebody's going to be wrong. Okay.
Yep.
Somebody's wrong. I could be wrong. The market could be wrong. Who's wrong? Whoever's wrong is going to lose money. Whoever's right is going to make a lot of money.
Yeah, and based on this, I think you're right. At the prices that you're buying it at today, you're right, because they're still growing. I mean, I'm looking at double-digit growth here. I'm looking at a great PE. I'm looking at a company with a A credit rating. The reason I'm not interested in it is I'm a retired guy. I need income. They don't pay any income.
Mm-hmm.
And as I transition, once I start Social Security, that's going to take care of a lot of my expenses. So I will move to more growth at that point. But today I need the income.
Mm-hmm.
They're not an income payer. I can look at paper gains all day long, and that doesn't put food on the table for me. So what you're saying, I think, is exactly true. There's probably not been a better opportunity to buy this company as there is right now. But if you bought even in 2021 to now, you've lost money
Yeah.
if you've held it.
Yeah. And
And despite being underpriced and the market was paying way too much for it here,
mm-hmm.
because the market's saying it's today, right today, it's worth this. So,
Yeah.
but basically, I think you're right. I mean, right now, if I was really a growth type investor, and I will be transitioning to that, and I have been doing that over the past year, this is a great opportunity in my mind.